2,600, that's about what, about 8% higher than where we are right now. Why?
So several factors, I think, at this point in time. So I think the expectation that the Fed cuts policy rates at some point this year, regardless of when that will come, I think is a supportive factor for gold. I think investor sentiment is very strong, and they have the space to add allocations. And I think the official sector buying, which we expect will continue, has created a strong base for the market.
Official sector, you mean central banks?
Central banks and other official institutions.
Okay, all right. So here's the thing. You said, look, when the Fed starts cutting, that's going to help, right? It's going to bring yields down. It's obviously going to soften dollar up as well. And we're back to this inverse relationship between gold and dollar, right? Why are we going back to this? Because the rally we've seen in gold has been despite the fact the dollar has been strong and yields have been high.
Yeah. I think the stronger negative correlation is really with real yields, and that's because it is the opportunity cost of holding gold. So the lower it goes, the cheaper it is to hold that position. I think with regards to the dollar, gold has been resilient in this environment where there's a lot of macro uncertainty, there's a lot of geopolitical risk. So we do see gold and the dollar being strong at the same time, and that shouldn't really be a problem, both being seen as sort of safe haven assets.
Okay.
Joni, it's interesting, isn't it? When we look at and break down the central bank demand, it's been driven by developed and developing central banks, countries, central banks in those developed and developing markets. On the developed side, even Singapore has been increasing its gold holdings. What's been behind that? So
the official sector gold buying has actually been going on for more than a decade now, and it's really been driven by the need to diversify reserves. I would say the large portion of that has really been driven by emerging market central banks, with the developed market central banks, generally holding high gold allocations from before, basically a legacy from the gold standard. So it's really the emerging market central banks that have been driving the build in gold reserves over the past decade or so.
And is that set to continue, or does it feel like we've seen the high point of global central bank official sector buying?
I think in terms of volumes, it's probably a bit challenging to match the high levels that we've seen over the last couple of years, which is over 1,000 tons. But we expect that the volumes will remain elevated from a historical standpoint. We think there's still room for central banks and other official institutions to add to gold reserves, to diversify their portfolios in an environment where there's a lot of macro uncertainty, geopolitical risks are high. So we do expect this trend to continue for a few more years.
All right, so plus 8%.